Let's talk housing. U.S. rents and home prices are diverging. Depending on which measure you look at, rents are either rising slowly or they're falling outright, while home prices, after a slight dip last year, are now climbing again. The gap between the two is well above the levels that preceded the last housing crash. Bloomberg opinion columnist Justin Fox says, don't panic just yet. Justin joins us now. So before we say don't panic just yet, what leads what here, rents or home prices?
I mean, in theory, rent is like dividends or earnings for stock prices. It's sort of the flow that justifies the price of the assets. I mean, in reality, housing prices don't work that way a lot of the time. And clearly, in the early 2000s, there was this irrational exuberance, some people might have called it, that drove housing prices up, and then they fell a lot. And so the question now, you have this divergence again. Is it that again, or is it something else? And there's this cool, so I initially just looked at the chart showing how high it is and was kind of, whoa, I think I will panic. And then I came across this very cool paper from earlier this year by Lara Lowenstein of the Cleveland Fed and Paul Willen of the Boston Fed, where they sort of take all the transactions apart and just look at the price to rent ratio for rentals that have changed hands. And they find that hasn't gone up so much. What's gone up a ton is the price of owner-occupied dwellings versus the price of renter-occupied dwellings. And when you think about it, we just had this pandemic where everybody's fleeing the cities, and even after they stop fleeing the cities are thinking, oh, I need more space because I'm going to work at home 3 days a week. And so there was just this shift in demand to houses and away from apartments. In the U.S., apartments are mostly rentals, houses are mostly owner-occupied, so it's kind of a rational shift that's happened. That doesn't mean it's sustainable forever, but...
Well, that gets, I do want to talk about the sustainability because, I mean, when you look at the data, it's very clear that the shift that you're talking about here. But the underlying trend still seems to be, obviously, price pressures up, whether it's on the rental side or on the purchase side here. How does that get reconciled down the road, if at all?
Well, I mean, I think right now the rental market is working better. Not in New York City, but in places with a...
Yeah, nothing works well in New York
exactly.
City.
But in other places, there's been a ton of new apartment construction. Prices are going down in a lot of cities. The housing market is just stuck right now because the people who own houses, who have mortgages that they took out before the beginning of 2022, they'd have to be crazy to leave. I mean, I'm one of those people, and I don't really want to leave. But so the housing market, the purchase market is kind of stuck. One assumes it's going to come somewhat unstuck if and when interest rates keep falling, mortgage rates keep falling. And that's sort of the interesting, so that will make it cheaper for buyers, but it will also mean a bunch of sellers who've been holding back might jump out. The general consensus seems to be that prices are just going to sort of mosey along, maybe drop a little, maybe rise a little.
Drop?
Not drop much.
Oh, okay,
When you say unstuck, when interest rates start falling, mortgage rates start falling, unstuck in what way? Meaning home prices will surge because the borrowing cost has come down, and so now people can act on the need to buy homes?
Well, but that's on the demand side, that's going to happen. But on the supply side, presumably more people will be willing to sell, simply because they won't be taking such a hit by getting out of their current mortgage and moving into a new one. And just as time goes by, those people who have pre-2022 mortgages become a smaller share of homeowners. So, yeah, it's interesting. My colleague Matt Levine suggested a while ago, well, if you just let people buy back their mortgages at market value, which is a lot lower if you have an older mortgage, that would be great. That would unstick things. And in Denmark, you can do that, and house prices have fallen like 8% there.
Yeah, okay. So Denmark, that's what we should be going after right now?
It is frequently brought up as like a better sort of mortgage market than we have. But
well, I all those countries are better than us, but they're also like tiny, you know, so you could do a lot of good things there when you got like a population that's a tenth the size of us. Justin, another great column by Justin Fox, a Bloomberg opinion columnist here, also a great author, by the way, as well, that you should check out. I am curious here, Scarlett, because everyone keeps talking about this idea that people are kind of stuck in their homes, right? If you're sitting on, say, a 3% mortgage, there's not a lot of incentive to sell your house and take out a 7% mortgage. But what's the threshold, do you think, where maybe people are unleashed? Because it's not necessarily just 3%. I mean, obviously, if it comes down a little bit, maybe people people will find that the differential between a 3% mortgage and maybe a 4.5% or 5% mortgage is something they can
I think you hit upon it. I've been reading that 5% is kind of the magic number where people are willing to transact. 7% is just like, that was in my parents' lifetime. I'm not going there.
Yeah.
But 5%, you start talking about it. And of course, home builders have been able to offer lower rates. They've been subsidizing some of that. So 5% seems to be a number there that they're comfortable with.
Yeah, and and it gets to this idea too about, he kind of struck me when he said the prices were dropping, because you get historically, technically prices don't ever really drop. They just maybe stagnate for a little bit before resurging again. And here in New York City, it's just all an absolute
it's all up
mess. All right, let's have a more pleasant conversation coming up after the break here. Land's End, earnings are out. Investors like what they heard. We're going to have a conversation with the CEO about those results and the holiday shopping season. That conversation up next, right here on Bloomberg. Shares of the retailer Land's End rising after the apparel company reported a big beat in third quarter gross margin that helped to drive an adjusted EBITDA that was above the consensus estimate. And right now, the share is on pace for one of their best days since the summer. Let's get right to it with Andrew McLean. He's the CEO of Land's End, joining us right now to talk about his results as well as the holiday shopping season. And Andrew, let's start off with those results here. We should point out still some softness when it comes to revenue growth or the lack thereof. Still some softness when it comes to the loss per share. But investors are really focused on that margin expansion and what actually drove it. What drove it?
We made a decision to look at our customer differently. We had been leaning into demographics. We really changed over to psychographics, and we found there were a couple of customer segments that really, really appreciated Land's End. And so we started to gear our product and our whole hierarchy of the brand around them. So we created ourselves as a solutions company, which wasn't that hard because we are a solutions company. We'll do anything to make you feel better about the dressing experience, from tummy flattening technology to swimsuits for mastectomy. People have had mastectomies, and it's been amazing to really be able to connect with the customer and give them more than just fashion, and that's been incredibly powerful for us. And the customers come on a journey with us this year, 3 quarters now of margin expansion.
I am curious, just in terms of the general trends that you're seeing with customers coming into your stores or into the website here. Do you see that the same sort of seasonality that other retailers see with the pickup that we kind of get in November and December for the holiday season, or are you sort of more evened out over the course of the year?
94% of what we do is done with a click from our customer perspective. So we actually start holiday early. We do have a holiday peak. It's not as pronounced as some retailers, but we certainly see a peak that begins in early October and actually finishes by mid-December with last shipping dates. And it really peaked around an incredibly strong Black Friday and Cyber Monday for us.
You talk about Land's End being a solutions company. What's the solution to reducing returns? If most people are done with their holiday shopping by mid-December, I assume you're gearing up for a flurry of returns in early January when people send back gifts that don't quite fit them or don't work for them.
Sometimes people look at our website and they get a little bit, there's too wordy and there's too much on there. But if you actually look on the product pages, we put a lot of data about fit, and we actually have a true size component. And that's been really great at helping to reduce the return tsunami that's been out there. And in addition to that, we're piloting technology. We talked about it on the call this morning with a company called Sizer that can take a picture of you for a second and really get your fit right at 90% plus accuracy. And I think it's these technologies that are really going to make a difference. And we'll always take our returns from our customers. We trade them back into the right fit. But there's a lot that goes on in that space. And some of it's very, very sort of old world in terms of just the words all the way through to the new technology. But you're right. It's a big deal in our sector.
So I also wanted to ask you, you mentioned technology. AI is part of that whole sizing technology that you're bringing to bear here. But what about the new technology in healthcare, which is weight loss drugs? I'm wondering if you have seen any kind of impact, or you anticipate any kind of impact in terms of people needing to buy brand new wardrobes as a result of losing significant amounts of weight.
That's a great question, and something I've been waiting to see all year. I haven't seen any evidence of it yet. Sizing curves had actually got larger through the pandemic, and they've stabilized at the moment. So we've not seen those start to fall. But part of me thinks that there's going to be a little bit of comp embedded in our industry over the next year or two as those weight loss drugs start to bite, and we'll see people changing their wardrobes out. One of the things you do get from Land's End, and one of our solutions is we can sell you product that will accommodate you through at least 2 inches, if not more, change in your waist size, and already has tummy flattening technology in it. So we don't even think you need to get to the weight loss drugs. And if you do, our product will still fit.
All right, Andrew, I am curious about, give me the growth story here, a longer term. I mean, obviously, Land's End has been through a few iterations over the last few years. I know the retail footprint isn't quite, I guess, what it used to be when I was younger. You still have a sizable presence there. Is there an expansion plan either through brick and mortar or through other means?
You know, it's interesting. Rather than bricks and mortar, our physical manifestation of the brand, and it is important, is catalog. That was our heritage. It was a channel, but now it's a marketing vehicle that really supports, and underpins our digitally native footprint. And that's what we're going to continue to lean into. Our energy is in what are those journeys of the customer from that physical manifestation, digital manifestation, and we're going to go with that. I find stores to be really expensive way to gather customers, and I look at a lot of the pure plays over the last few years that spent lots of money trying to get customers from stores, and you're committing a lot of inventory. There's a lot of build out costs, and I think we can do a great job with our existing customer base, and then using the catalog both for existing customers and to prospect with as a vehicle to drive the brand forward. I'm not saying never to stores, but right now we think we got a pretty good running road ahead of us with what we have in hand.
All right, Andrew, great to talk to you. Andrew McLean there, the CEO over at Land's End. A lot more coming up here on the show. We are getting some breaking news. This involving a written testimony, the prepared testimony of various bank CEOs scheduled to go on to Capitol Hill tomorrow. David Solomon at Goldman Sachs, Jamie Dimon over at JP Morgan. This is the countdown to the close, just about 2:30 here in New York. The price action in equity markets to the downside. Interesting moves in the Treasury space. Let's get a check on what's happening in commodities with Abigail Doolittle, who's standing by with our commodities close.
So we've got some weakness for commodities remain. Overall, the Bloomberg Commodity Index down about 0.4%. Two macro factors. I think first, the credit downgrade of China. Some people are equating that with some sort of economic slowdown, demand slowdown. So that's weighing on a lot of the commodities. Of course, China is the world's largest user of natural resources, and we have the up dollar. So take a look at gold down for a second day, suggesting that maybe we are going to see a little bit of a continued reversal of that massive rally that we've had more recently. Silver down too, sort of a precious metal and an industrial metal. Copper down 1.2% and nickel down 3.6%. These industrial metals that would match up more so with the China story and the dollar weighing on all. In fact, let's take a look at the dollar, because over the last week we have the Bloomberg Commodity Index down 2.4%. Well, Romain, take a look at that dollar down 0.9%. It might be a big question for December. Are we seeing a bottoming process for the dollar?
Yeah, absolutely. Thanks there to Abigail. Do a little closer look at what's driving the moves in the commodity space. We do want to go back out to Dubai for the latest on the UN climate conference, where negotiators, they're struggling to agree on a final text over the future of fossil fuels. Bridgewater Associates founder Ray Dalio spoke with our very own Francine Lacqua during the Bloomberg Green Festival at COP28. She asked him if the goals of the climate summit can actually be met.
Let's be realistic. We are unlikely to achieve the 1.5 target. So there are three things. What you can do to achieve the 1.5 target. The second is adaptation. Okay, if you don't achieve the 1.5 target, what needs to be done to make that acceptable? Of course, the consequences of not doing that are big. Big migration, all sorts of problems. But how do you adapt? And then the third cost is the cost of the damage. I believe that we're going to be moving in an economic way to adaptation, and that there's a lot of that'll have a great power. And the reason is it affects everybody. So whereas there's an element here of let's be good and get the money. But if you go to, let's say, banks, they say banks have a lot of money. But banks have assets and liabilities. And if they don't receive or give their depositors or those who are putting money with them an adequate amount of return, they won't have any money.
Right.
So you still have to have the return component of that. What happens is self-interest is a great motivator when you have that. And I think adaptation will be some area for probably great investment and great productivity.
But right, isn't climate change the biggest risk really to any company? And so when does it actually, when do we see regulation that forces every company to look at it as the longest, biggest risk out there?
Well, I think Secretary Kerry did such a wonderful job of describing the realities of that. I mean, I think that's the balance. And so as a very practical person, one can't say it's going to be all or none. One has to look at actually what is it, what is happening. And I think as you're dealing with the regulation, that's right, that's good. And then there's also a meme developing that you're not a good citizen. Okay, that political aspect also plays, social aspect, plays a role. Are you doing it well? Is a social pressure that has a role. So there's regulation, there's social pressure. Those are all good things that are helping. The real question is that enough? I mean, it's not like you have them or you don't have them.
And that was Ray Dalio, the founder of Bridgewater Associates, speaking earlier today at the UN Climate Summit, talking about the end of free money making climate fixes more difficult. He mentioned U.S. climate envoy John Kerry, Romaine. The U.S. representatives, whether it's John Kerry or Al Gore, the former vice president, are naming and shaming while they're there. Yeah. Kerry called out Chevron for not signing on to a pledge to end methane emissions, and Al Gore also called out Saudi Arabia for having too much sway when it comes to these things.
Yeah, I saw that, and of course, this is being held in Qatar, which is a whole nother conversation. But it gets to this idea, though, too, as to does naming and shaming really work at this stage? And I thought Francine's question kind of about the idea of the economic impact and, more importantly, the corporate fundamental impact. Shouldn't that be really what's driving this? And I don't know. There's obviously a lot that has to be reconciled between whatever our future is going to hold and obviously the past with fossil fuels. But at the end of the day, we know what drives most of these companies, and that's profitability.
Profitability.
If you can make a case that it's profitable for them to make that switch, they'll make the switch. If you don't make that case, guess what? They're not going to make the switch.
It's not going to happen. Or you can incentivize them to make the switch.
Well, yeah, that's the stick approach, but you would need like a functioning Congress to do that.
Well, that's something we can all dream about. We can be aspirational when it comes to that. All right, still ahead on the close, we'll get a view from the sell side about how food and grocery delivery services can perform heading into 2024. This is the close on Bloomberg.
Let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with GitLab. Truist, raising its price target to 70 from 65. This after the software company's third consecutive earnings beat. The analyst citing improving demand and calls GitLab's guidance conservative. Shares having a great day, up almost 13%. Next up, lithium supplier Albemarle knocked down to underweight over at Piper Sandler due to a significant drop in global lithium prices, specifically in China. Piper Sandler says the problematic market environment could undermine a rebound in pricing for at least the next few quarters. Those shares down almost 6% on the day. And let's take a look at UBS, a downgrade to neutral, this over at Bank of America. While the European bank's acquisition of Credit Suisse has strategic benefits, the analyst cautions that 2024 will require some heavy lifting and high operating costs to integrate that bank. Those shares down about 2.5% on the day, and those are some of our top calls. We want to stay over in Europe right now and pivot to the food and grocery delivery services sector. Monique Pollard joining us right now to share her outlook on the sector. She's co-head of European Internet Equity Research over at Citi. And Monique, let's get right to it. It seems like kind of a tale of two cities, because you take a look at some of these companies and they seem to be doing pretty well. You take a look at a few others and they don't seem to be doing well. When you look at the divergence, say, take a Just Eat, compare that to Deliveroo, what is the differential there that seems to be driving these stocks in completely opposite directions?
Yeah, absolutely. Very good question. Well, I think you've got a couple of things that you've got to bear in mind for all these online food delivery players. Firstly, they're really hyper-local businesses. So when you're looking at sort of overall performance of the company, what you might find is that what you're seeing at Just Eat Takeaway in some of its markets that overlap with Deliveroo, the forecast and the numbers changes might not be that different, but in some of its market, it might be doing a slightly worse job. If I think particularly about Just Eat Takeaway, it's got some good momentum in some of its core markets, like Northern Europe. That would be markets like Germany, the Netherlands, and UK and I. And where it's doing slightly worse is US, where its business effectively is sort of up for sale, and some of its Southern European markets. If you look at a company like Deliveroo, right, I guess we're seeing just slightly more consistent performance from that operator across many of its markets, including UK and I, its biggest market.
Well, let's go back, though, to specifically with Just Eat, too, because I was kind of intrigued. I mean, you have a buy rating, if I have this right, and correct me if I'm wrong, and a price target that's around, it looks like 23 euros or so, which is pretty aggressive compared to where the stock is right now, and certainly how far it's fallen over the last few weeks and months. What gives you that confidence that we could actually get up to 23 over the next 12 months?
Yeah, well, part of the view on Just Eat Takeaway is that there is the potential for value unlock from strategic action. So, management have said since April 2022 that they're open to a full or partial sale of Grubhub. That's the US business of Just Eat Takeaway. And basically, we think you're effectively waiting for the New York fee caps to be lifted as a catalyst for any asset sale. So there is a proposal to lift fee caps in New York that's been referred to the Committee on Consumer and Worker Protection, but that hasn't yet been approved. So any progress we might see early in next year on fee cap removal in New York, because New York is the majority of revenues for Grubhub, that would be a material positive catalyst, as it could signal value unlock from the sale of that asset.
You mentioned that possibility. Is that what's needed in order for there to be a wave of consolidation in the delivery business?
Yeah, it's an interesting question. I mean, we've seen a little bit of market repair and some exits in 2023 as all the operators have been trying to push forward to profitability and some cash flow generation. But we haven't seen any, I guess, more major consolidation this year. I think effectively there are three bits of consolidation that the market and investors are kind of waiting for and hoping for in 2024 in the space. Firstly, as we talked about, there's the potential sale of Grubhub for Just Eat Takeaway. Second, another popular topic of investor debate this year has been Deliveroo as a potential takeover target, particularly from April next year, when Will Shu, the founder and CEO's Class B shares, which give him over 50% of the voting rights, expire. And then the last bit of consolidation that people are sort of hoping for is the potential for Delivery Hero to sell 7 of its Food Panda markets in Southeast Asia. And that was a story reported in the press on September 20th, which the company confirmed but said negotiations were in preliminary stages.
All right, thank you for itemizing those. Monique, I know that you don't cover U.S. delivery companies, but I'm curious to get your take on Uber. What are the synergies that a company like Uber, whose primary business is ride sharing, can exploit that versus a standalone company that only focuses on delivery?
Yes, so as you say, I don't cover Uber, but if I was thinking more broadly in the sector about sort of synergies from other verticals, I guess, one example I could think of is, we've seen all the food delivery companies over the past few years start to deliver groceries. And we actually saw Deliveroo at its capital markets event last week talk about expanding also into retail. I think the synergies you can get from sort of offering multiple services on the app are really twofold. Firstly, you've got a last mile logistics network. If it's profitable on a contribution basis, clearly the more volume and orders you can put through, the bigger the overall profit pool and the bigger the greater addressable market. And secondly, all these operators are consistently looking at how to continue to engage the customer base and keep retention very high. And the more services that you can offer, obviously allows you more opportunities to engage with that customer and retain that customer.
Monique, great to catch up with you here. Interesting report and interesting commentary. Monique Pollard over at Citi, a closer look at some of the European delivery stocks here, Scarlett. And I'm glad you kind of brought a circle back to the U.S. because obviously these companies are very similar in a lot of ways, obviously serving very distinct markets, but very similar in the structure here. And I wonder why these sort of business models work in some markets, but in other markets they seem like there's not really a whole lot of profit to be had.
Yeah, and it's also curious because I think it's limited to certain, not limited, but it's definitely customized to certain kinds of food in certain geographies as well. If you go to Chinatown, New York City, they all have their own food delivery service, which are these two Chinese companies that I see their logos for everywhere, but it's not like they deliver Shake Shack in the rest of Manhattan.
Yeah, but that's probably a good thing too, because we got to this point where there were kind of like 2 or 3 companies, at least here in the U.S., or at least in New York, I should say. It's kind of the only game in town, and you've kind of seen that broaden out as I think a lot of people got upset with the fees at Grubhub and Seamless.
It can be as expensive as the food itself.
Well, I mean the restaurants that are basically getting eaten into on those fees, and you mentioned the Chinese delivery companies. Maybe that's a better proposition for them. All right, coming up here, our Wall Street Week Daily segment is coming up next here. Sit down with Aaron Chatterjee, professor of business and public policy at Duke University, about what he anticipates to be some of the potential economic issues for 2024. This is The Close on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day around this time. And David, at this time of year, everybody's looking ahead to the next year and wondering sort of what is in store for the market.
Exactly. It's just what we thought we would do, actually. It's time to start thinking with it, particularly in a presidential election year, because who gets elected will really affect the economic policy. So we thought we'd ask somebody who had been in the White House administering economic policy about what we could expect in 2024. So we talked to Ronnie Chatterjee. He's professor of business and public policy at Duke University. He served on the White House National Economic Council as the CHIPS coordinator. This is what he had to say about next year in economic policy.
Well, the first issue is going to be, will the economy continue in the direction it's been going? A lot of people at the beginning of 2023 were saying we were headed for a recession. But now, nearing the end of the year, we've seen inflation at least start to moderate, growth reaching the highest rate in the United States in the last 2 years, and the job market continuing to be strong, with unemployment still below 4%. So we're moving more towards a soft landing that many folks thought would be unlikely than we are towards a recession. And the question is going to be, in 2024, do we continue that trajectory, or is there a disruption that's more significant? And that really, to me, is the biggest question about 2024.
And that job market is supporting, among other things, the consumers, who are really supporting the entire economy. In 2023, the job market was relevant not just for that, but also for all those labor disputes. Is organized labor going to be as big a factor in 2024 as it was in 2023?
Well, my gosh, 2023 was a banner year for labor. So it's hard to imagine that 2024 could be even more significant, but it's possible. And here's why. In 2023, labor achieved several key wins that really have been unprecedented in recent labor history. You think about UAW with strikes at all the big three, with a really bold gambit to try to secure 25% increase in wages over 4 years, and they succeeded. And that's going to send a signal to a lot of other industries about what's possible. The big question will be whether UAW can expand that organizing effort to places in the South, to foreign automakers like Hyundai and Honda, and of course Tesla, because really this is about the future of electric vehicles and how technology is changing the way we make automobiles. That's what's at stake, and if UAW manages to do that in 2024, it will be an even bigger story than it was in 23.
Ronnie, what about stimulus, particularly fiscal stimulus? Because there's still money coming down the pike from the Inflation Reduction Act, from the CHIPS and Science Act, things like that. Is that going to kick in 2024, and what effect might that have on the U.S. economy?
I think you will begin to see the impact of the CHIPS and Science Act, particularly the subsidies to build manufacturing here in the United United States, you've already seen about $200 billion of committed capital investment. The question is, are you going to see more money coming from the federal government to support that? The Inflation Reduction Act, yes, the tax credits will continue to stimulate investment. You've also seen hundreds of billions of dollars in solar, in wind, and EVs. And that's going to continue in 24 and help support the economy as well. I think there's a question about global growth, though. If you look around the world, some of our strongest historical economies aren't doing as well. So I'm keeping an eye on places like Germany and, of course, China, which has been weaker than it's been in a long time. India and Japan have been the bright spots. We'll see if that continues.
China, big subject, has to be second largest economy in the world. It is also, you may have noticed, a presidential election year in the United States, and there seems to be a fair amount of hostility on both left and right now to China. Is this a year where there can be any further progress made in trying to figure out how to deal with China? Don't give in to them, but also don't keep them out.
I don't think you'll see any big milestone achievements. What I do think you'll see is a lot of talking. And talking isn't necessarily bad. President Biden sent 4 of his cabinet secretaries to China in the last 6 months. He met with President Xi in San Francisco. And while you didn't see big agreements coming out of this, the dialogue was important to keep communication lines open. At a time where there's a lot of tension across economics, politics, and military, those conversations help keep the temperature turned down. And you're seeing President Xi in China take some steps to open up his economy. They just allowed a bunch of European countries to come visit, their citizens to visit China without a visa. It's a symbolic move, but it suggests that he is hearing the calls to open up his economy.
Let's talk about tech. I mean, 2023 was certainly the year I first heard about generative AI through ChatGPT, one of the great marketing devices, I think, of all time, if it's nothing else. How big a factor will generative AI be in 2024?
Oh, I think it's going to continue to be a banner year for AI, for large language models, and particularly ChatGPT, the technology that became the fastest growing consumer application in history. You saw this with Sam Altman's removal and then sort of replacement back as the CEO of OpenAI. It was a huge national news story, not just on the business pages, but around the world. And I think you'll see OpenAI be the center of many different discussions next year. The key thing about AI is, as this technology moves forward, is it going to replace you and me and do our job, or is it going to complement us? Is it going to be our co-pilot and make us better? That's really what's at stake when it comes to AI.
And we hear from various experts in artificial intelligence, what we want is it to be supplementary rather than replacing humans and what they're doing. Can the government help nudge it or direct in that direction? We now have this big executive order, I mean, a pretty extensive executive order that's going to play out through 2024. What role can the government play in making sure we direct generative AI in the right direction?
Calling for transparency and accountability is the key thing. We don't want the government's bureaucracy to inhibit innovation in AI. When you see the amazing advances that have happened, some of it comes from federally funded government research, but in the end, it commercializes into for-profit companies that are developing the next generation of large language models and generative AI. But we have to make sure that we stay within the bounds of what society can tolerate. We have to make sure that we're not letting AI develop dangerous applications around autonomous weapons without the kind of supervision you need from the public trust. And so that's where I think government can play a key role, not inhibiting innovation, but setting the rules of the game where which we operate. That's what the AI executive order is all about.
Which government? Because it's one thing, that would be a tall order if it was just the United States. We didn't have to worry about anything else. But this is almost inherently a global phenomenon, where you can have competition, you have an arms race, essentially, in generative AI. What are the prospects of our really getting together with other countries to really agree on what the ground rules are?
I think the prospects are bright because you see AI affecting societies all over the world. The Chinese government has a strong interest, of course, in how AI is being used. The French have an interest in AI. You see one of the most exciting AI startups was founded in France. And so I think you'll have a lot of countries coming together. They're definitely going to have different priorities, however, and you're seeing that reflected in COP28. The same kinds of discussions that make global climate such an important issue are going to make AI the same kind of discussion, but it's going to be just as hard to make progress. It doesn't mean we shouldn't try, but I wouldn't expect any big breakthroughs in 2024.
That was Ronnie Chatterjee of Duke. And then on Thursday, we have something special, actually. I'm going to go down to Washington and spend a half an hour, actually, with Catherine Tai. She's the United States Trade Representative, talking about U.S. trade policy.
All right, a great conversation to look forward to from David Weston on our Wall Street Week daily segment here. Meanwhile, we round out into the final hour of trading here on the close. The price action in the equity market similar to what we've seen over the past few days, similar moves that we're seeing again in the Treasury space. But this is a day where there is a big pushback right now on that rally, a big pushback on the narrative of Fed rate cuts. This is Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Scarlett Fu. Markets, or at least equities, not doing a whole lot today, although bond yields have resumed their decline.
Yeah, though we did see a little bit of a flip-flop from what we saw over the last few days, where you had the Russell and a lot of the cyclical names outperforming the broader market. Today, it's a flip-flop of that, with the NASDAQ modestly higher here on the day by about 0.2%. Meanwhile, the big laggard are those small caps and mid-cap names. That was the big question yesterday, Scarlett, was whether there were going to be legs to that rally, and at least for one day. I guess the answer is no.
Yeah, I mean, they had been outperforming for a few weeks, but, you know, you got to take a breather every now and then.
Yeah, the other thing I was taking a look at, and we can flip up the board here, because I was taking a look at sort of the overbought conditions that we reached on a lot of the major indices, and whether that was a big part of the reason why we maybe saw a little bit of a tamp down in the price action over the last few days. You can see the S&P 500 did hit that threshold, that 70 level, which is the dividing line between overbought territory here. And the idea that, well, anytime you hit that, and Abigail Doolittle is always very prescient in pointing these out, that those technical levels, when you hit that, you always seem to have some sort of a softness immediately after that. Doesn't necessarily mean the trend completely reverses, but you certainly get that technical softness there, and I think we're seeing a bit of that now.
Yeah, you can stay in overbought territory for a while, which is what we've been doing, hovering around these levels for about 14, 15 days. Let's take a look at some of the individual movers here that I'm focused on.
Is Land's End on there?
Land's End is not on there, but I do have another retailer on there, and this is Designer Brands. It's the owner of DSW Shoe Stores and the Keds brand.
Which I didn't know still existed.
Yeah, it does still exist.
Yeah.
It cut its annual EPS guidance and now sees full year sales at the low end of its previous target. That's the consumer, once again, cutting back, being more discretionary.
I was actually very interested in this story because I would have thought that DSW and Designer Brands, I thought they cater to kind of a lower income or middle income consumer.
Or people looking for deals.
Right, but the price point was set where I would think they would be a little bit more recession resistant.
Yeah, maybe people are finding better deals just from the full price retailers themselves.
Yeah.
I'm also looking at GitLab. It reported earnings after the close yesterday, rising as much as 16% in trading today. The application software company had a beat and raise quarter, and for the year, it is now up 31%.
Yeah, a company I always forget that it's a for-profit company and not a research lab like,
right, give it the name.
The old one. So, go ahead.
All right, and of course, we've been keeping an eye on the rise in cryptocurrencies, in particular Bitcoin, which has actually led to an increase in Robinhood because it is up the most in 11 months. The online brokerage saying crypto notional trading volumes in November were up about 75%.
I thought everybody had given up on Robinhood.
Not so many people.
Oh, that's interesting. Well, good for them. First of all, I applaud them. I mean, it's good to see the meme stocks coming back. So I should point out, I mean, not to go too off the reservation here, but I was in a GameStop this weekend.
And?
It was awful.
It was awful?
Yeah, I don't know if it was just that one store. Maybe I just picked the wrong one, but I don't know. I was like,
it was not a good experience for you.
I was like, okay, all right, I'm out.
Roaring Kitty, explain why you still like it.
All right, 1 hour away from the closing bell. Cross-platform coverage of today's top stories. That coverage starts right now.
Down to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Scarlett Fu. We're joined right now by our colleagues, Carol Massar and Tim Stenovic. Welcome to our audiences in full across all of our Bloomberg properties, television, radio, originals, and our partnership, Carol Massar, with those folks streaming on YouTube.
Yes.
How are you, Carol?
I'm doing well. How are you doing?
You said yes 3 times, so you're in an agreable mood today?
Yes, I am in an agreeable mood.
Should we have a meeting about it?
I got some sleep. The puppies
I
didn't
missed
wake me
you at
too
the
early.
meeting this morning.
There was a meeting. Having said that, it's once again about the Treasury trade, and I know we're going to get into that, but some weaker data in the labor market, the JOLTS job openings, that number going below 9 million, but we're hitting a 2-year low in the month of October. So again, the Fed probably saying, yay, because of that softening job market. Having said that, what we don't say yay about is meetings. And it turns out Salesforce, Slack, Technologies found out that 2 hours is kind of the tipping point in terms of meeting. Anything after that, and our productivity falls off.
Wait, 2 hours in total, or 2 hours?
2 hours in total daily, although I got to say.
Can you imagine a 2-hour meeting?
2 hours of meetings daily to me is a lot.
Yeah, my eyes are glazing over just thinking about it.
Well, it turns out if you spend over 2 hours in meetings each day, you don't actually get anything else done, and you have to end up doing that work outside.
Can you say that a little louder for the people in the back?
What do you say? You know, it's funny. Shopify added a tool to its calendar earlier this year where it actually took the average salaries of people who are at a certain level in a meeting to show how much a meeting costs to try to get people to not have meetings, because time is money. I used to work for a company that, like, over 10 years ago did this. There were signs up in every room that said, you know, the average meeting, half-hour meeting costs this much money. Do you really need to be here right now?
Yeah.
That company didn't end up doing very well, I would say.
Oh, there you go. Correlation is causation, apparently, here. On a somewhat related note, though somewhat unrelated as well, I just found out, did you know that some Dunkin' Donuts actually have conference rooms that you can rent out by the hour?
I had no idea.
Yeah, I just found this out the other day.
Do you get donuts if you rent out the conference?
Only if you stay for more than 2 hours.
You know, that's really interesting.
So many questions about this.
Yes.
It's like...
why? Like, why?
Because people are trying to work everywhere they are, you know?
Meetings, Scarlett. There's always a meeting, and you need a place to have a meeting.
Yeah, I'm allergic to meetings.
Good thing you didn't say donuts.
No, I'm not allergic to donuts. We mentioned the softening labor market. One thing that's come up in the softening labor market is that job applicants, those who are looking for jobs, are now being assigned homework, unpaid homework assignments, in order to determine whether they're the right fit for any kind of company. Yeah, they're being asked to do things and submit it in a day or two, and so they can work on something for a weekend or a couple of weeks, and then submit it to be considered for a job.
I'm sorry, are they doing work for the company?
Essentially, yeah.
For free?
For free.
Yeah, to prove that you are the right fit.
To prove it.
Unpaid internship.
Unpaid, right.
It's an audition.
It's an audition.
Yeah.
Wasn't your previous job the audition? Or
you would think. I mean, this might be.
Resumes.
Isn't that why we have resumes?
This might be part of the idea where they're not relying on credentials. They're looking more at your skills and your capabilities. And it's one way of testing.
Or see what you can do under pressure, right? Like you've got a week. What can you come up with?
A week?
Well,
I mean, I've been on job interviews where they give you something like and say, okay, you have an hour to figure this out.
How
and
many
then you can go
jelly
home
beans are
back
in this
to your
jar?
life. But you're telling me that when I leave, I have to spend 2 weeks working on your work?
Yeah, but it actually brings up real issues. And Carol and I were talking about this a little earlier. It sort of is another indication that perhaps the labor market is softening a little bit. If companies are, you know, really out there looking for talent all around the country, are they really going to make applicants jump through these types of hoops in order to find the right talent? And there are some downsides to doing this. Like, if people, you know, have a job already or they're taking care of a family, like, are they really going to be able to spend a week doing a, you know, C++ programming project just to apply to a job?
They will if they can.
Yeah, if they can.
And maybe get some free work done.
But then the folks who can't do it don't end up applying to that job. But the company misses out on that employee.
You might also lose out on some really good applicants who, that given maybe a few weeks or a few months on the job, could turn out to be a really great employee, even if they don't have the skills right there at the application process.
Did you guys take a test when you came to Bloomberg?
They put me in front of a microphone with a 4-box with you guys. Rehearse this.
Did they?
No, they didn't.
It is. This is his audition. People don't know.
This is an audition.
Tim for the last
It's the ongoing audition.
It's been 3 years, but...
I think I had to do a writing test where I had to prove I could put together a sentence. And someone said, yes, you can write a sentence. Okay.
I had a test.
It was harder than that.
I had two tests. I had written and then I had an oral exam.
This is over. It's already 2 hours.
Can we talk about that?
We did talk about that. Okay. All right, we're going to be back in less than an hour's time. Our cross-platform coverage covering up the market.
When she wants to say goodbye, then she says goodbye.
Sometimes I do, sometimes I don't. Anyway, our cross-platform, radio, TV, YouTube, Bloomberg Originals. We will see you at 4 p.m. Wall Street time for Beyond the Bell.
Continuing our coverage here on Bloomberg Television, counting you down to the closing bell. Just about 50 minutes until we get there, and quite frankly, just about 3 weeks or so until we get to the end of 2023. A lot of Wall Street firms now out with their year-end S&P outlook for 2024. RBC at 5,000 for the S&P 500. That's where they see it ending 2024. Lori Calvasina joining us right now, head of U.S. equity strategy over at RBC Capital Markets. I hope I got that right, Lori, and didn't misrepresent it at all. 5,000, I mean, it's not far away, but it's kind of ahead of the pack where a lot of your peers at other firms see the S&P ending. Why?
Well, look, I think the big thing that's a differentiating part of our forecast versus others is that we see PE multiples as able to stay higher than many expect. Our modeling consistently shows that with a moderation in inflation that's anticipated for next year, a little bit of cuts in interest rates, that we can see a low 20s PE multiple. If you look at some of the other strategists, they've been making much lower PE assumptions. They're still sort of stuck in the teens. People are doing a lot of work looking at sort of post-GFC type averages. We've actually done some modeling and based on data going back to the 60s and leveraging consensus forecasts for where things like interest rates and inflation are headed, the math tells us that multiples can be higher than most people expect. And I know that's very wonky. It's not the most exciting story, but it has been a big source of debate on Wall Street throughout 2023 as multiples have surprised to the upside, and we think they can do it again in 2024.
How does that look, though, on a historical basis? Because I've heard this debate, and some people will say, look, everything is stretched, everything is overpriced, and then somebody pulls out a chart, showing, what PE valuations and other valuations were like sort of pre-pandemic over the last, few decades, and they say we're pretty much in line with that, in some cases even below that line.
So I think what's important to keep in mind is that even when people do go back and look at, say, the 70s, and they say, okay, well, inflation was raging back then, well, shouldn't we have PEs, kind of down in the low teens, kind of the 10-time area, even something, a little bit below that. We say, look, inflation is not raging as much as it was back then. I think what also gets tricky, Romaine, is that we look at trailing PEs where we have more visibility as opposed to forward PEs where there's still a lot of guesswork, and that's really simply because of the data we've got available. But generally, we think the idea that multiples have to be a little bit lower than they've been in the post-GFC era, we think that's generally not a bad way to think about things. We are entering into a different era of investing, a different era of interest rates, a different era of inflation than what we saw in that pre-COVID, post-GFC era. But still, if you go back and do the math and take into account all that data back in the 60s and 70s, it tells you multiples don't have to come down as much as people think. And so I think that's really the key here.
You look at how the S&P 500 has performed this year, up 19%, the NASDAQ up 36% in 2023. A lot of people are wondering whether we've pulled forward the gains from 2024, given the banner month of November. And you think about within the presidential cycle, the 30 over of a presidential cycle, stocks do tend to do well. How does that set us up for 2024, which is a presidential election year, given that there's all kinds of unprecedented factors to consider here for this election?
So two great questions, Scarlett. And I would say first on kind of the, kind of big rally we had in November, Santa Claus definitely showed up early. We'll see if the Grinch ends up coming in December. Traditionally, if you look past the last 10 years, November is very consistently a strong month. December, like October, has been more mixed. I will say, though, that generally, I've been a strategist for a long time. I've been working in strategy for over 20 years. We always see investors and stock markets try to bake in the year-ahead outlook in November and December. So that's something we always have to contend with. And usually, to be honest, kind of the narrative about the year ahead does evolve a bit as you get into the new year. So I don't think there's anything too unusual there. I think the presidential election year is just something that's starting to come on investors' radars in the U.S. I think non-U.S. investors have been focused on it for quite some time, at least if you sort of look at our conversations that we've been having with clients. Usually, presidential election years are up, but they're a bit weaker than what we see in the preceding year. And I think that's evidence of the fact that there's always some amount of uncertainty that overhangs markets in a presidential election year, but they do usually manage to push up nonetheless. You actually tend to see pretty consistently gains after the election, whether you get a Democrat or a Republican. And I think that just speaks to the fact Wall Street can sort of handle any playbook that we get ultimately, but there is some concern when they're trying to figure out what that playbook is.
Right. They just need the overhang of the election removed from the scenario. We were talking earlier about how the Russell 2000 small caps have outperformed big caps the last couple of days. That has reversed once again today with the Russell 2000 trailing. How intrigued are you by what we're seeing in the Russell 2000 and small caps and this idea that finally there is reason to go in and look and exploit the value that's been there all along?
It's a great question, Scarlett. And as you know, I'm an old small cap strategist. I've spent about 7 years of my career covering that space. I saw one of my clients last week, and we were meeting. I was walking through why I was intrigued in small caps on the next year, why we're having a constructive stance, and we'll be telling people to add to positions. And he was kind of beating me up for not being bullish enough. And my response was, look, I've seen a lot of deep appeal in this space for quite some time. And so, if maybe my enthusiasm feels tempered just a little bit, it's that we've had a lot of fits and starts in this space, and the valuation appeal of small caps has not been enough to get them going. What I think has changed is that investors are finally, over the past month or so, ready to think about what you buy when the Fed starts to cut and when interest rates come in just a little bit. We've also had some of the worst economic fears of investors recede. So I do think people are buying more into the soft landing thesis, and that's really Goldilocks for small caps. I think you need to avoid the worst kind of recession for them to get going, but you also do really need faith that the Fed is finally going to be able to move interest rates lower. And I think that's what's really changed in the last month, is that investors are ready to make that call. We're also hearing, frankly, that small cap balance sheets not being as bad as feared is something that the companies themselves are starting to talk about. We've been telling people that for months based on data, and now the companies are going out and defending themselves on that point as well.
Yeah, making the case and proving it, and that you're seeing it pay off, I suppose, in the recent performance. Lori, really appreciate your joining us. Lori Calvasina is head of U.S. equity strategy over at RBC Capital Markets, with a 24 target of 5,000 for the S&P 500. Coming up on the close, the battle of the weight loss drugs. You've got Eli Lilly's new offering now available at pharmacies. It'll compete with Novo Nordisk's treatment. All the details.
Plus some earnings coming up after the bell. A focus on the housing market with Toll Brothers. We'll break down the latest numbers and what it has to say about the state of the housing market.
And fans of Grand Theft Auto are getting a look at the newest version of the game, GTA 6, but they're actually not going to be able to play it anytime soon. That's maybe why the stock is falling. All that and more coming up. This is The Close on Bloomberg.
Another mixed day in equity markets as we march to the closing bells here on this Tuesday afternoon. The Dow, the S&P lower on the day. The NASDAQ, modest gains on the day. The Russell and the mid caps, the big laggards here on the day. A bit of a reversal of some of the price action that we had seen over the previous couple of sessions here. Some idiosyncratic stories to keep an eye on, though. Birkenstock back above its IPO price. Some relatively strong earnings out of names like Land's End, J.M. Smucker, as well as Signet. And of course, we get Toll Brothers, as well as quite a few software companies after the bell tonight, including Asana and a few others. You take a look at the Treasury space, not much to see. You take a look at crypto, a lot to see there, with big moves once again in Bitcoin and Ether. Meanwhile, the VIX still camped out below 13, quite frankly, where it's been for the last couple of weeks. Abigail Doolittle joining us right now to talk a little bit more about this in our Options Insight segment. And Abigail, you're taking a look at some reasons why the VIX may actually pop higher.
Indeed. It would be hard to believe since we have seen it suppressed for such a long time. But given the fact that November was the best month in more than a year for many of the stock indexes, and there's so much uncertainty and other factors to consider. And one of them right now being the fact that correlations are rising. Steve Sosnick, market strategist over at Interactive Brokers. Great to have you back with us. And you put correlations, this 1-month correlation index, on my radar a couple of months ago. And when correlations are low, it suggests that people are looking at different stocks or aren't macro concerns. Talk to us about that and the fact that it's rising now, but we still have this VIX basically in the ground.
Well, yeah, see, one of the things is we think of VIX as the fear index. And I've said more than once, it's not a fear index that just plays one on TV. It's really, I look at it two ways. First and foremost is it's really the best way for institutions to get volatility protection in a hurry, and they're not seeking it right now. But the other part is mathematical. If you've got, say half the stocks in the index going up and half of the stocks in the index going down, well, the index goes no place. If they're all going in the same direction, one way or the other, the index moves faster. So when you have periods of low correlation, it dampens the volatility that's expressed by VIX and other volatility measures. But what we're starting to see now is, I use the CBOE COR1M index, which is basically a 1-month measure of correlation. VIX, by the way, is also a 1-month measure because it uses, average of 30-day options with an average of 30 days to expiry. And what I've started to see here is, like in September, the correlations stopped going down, started turning up, but VIX continues to mire itself along the bottom. That was a tell in September. Let's see if that, it's hard hard to say what happens in December, but I could understand why we might look at it that way.
Well, thanks to you, folks like you and Kevin Kelly of Kelly ETFs here on Bloomberg Television and Options Insight. We now talk about, we haven't for a year or two, the VIX as that uncertainty index. But in all seriousness, Steve, that chart that we were just taking a look at of the 1-month correlations to the VIX, whenever I see a divergence like that, it always gets my attention because at some point it's going to come back together. What way do you think this? Is the VIX going to follow higher? And I have to mention the VIX curve, it's really pretty steep, healthy, but steep right now.
Well, remember, VIX is looking 30 days out. So I think the market has sort of decided for itself that nothing is going to happen for the next 30 days. Now, at some level, you expect a low volatility December because, you have Christmas week, which nothing really happens, and, things will sort of come to a natural end. But it's a little premature to think of that when you have jobs numbers on Friday and a Fed meeting next week. And what's very interesting to me is I sometimes look at VIX 9D, which is the 9-day VIX. That's not showing a lot of nervousness even ahead of these two events, which can easily move markets and shake the market narrative.
Well, you know what is showing some life is the dollar, the Bloomberg Dollar Index and Dixie. We have both of those in what looks like it could be a bit of a bottoming pattern. And if that were to happen, the risk-off period from August, September, and October that really followed the dollar, surprising most of the market rallying. Do you think that in about 30 seconds, do you think that we could see something like that happen? And what's the why?
Well, the short answer is stronger dollar is not good for multinationals. The S&P 500 is multinationals. I think if the market decides that Europe is going to start cutting rates faster and more aggressively than the U.S. or other central banks will do so, that bolsters the dollar against them.
And all of that before what Fed Chair Jay Powell's message might be next Wednesday. I'm not sure that he loved the reaction last Friday, although that's just one person's opinion. Steve Sosnick, market strategist over at Interactive Brokers. Thank you for joining us for Options Insight today. And from New York, this is Bloomberg.
This is the countdown to the close. Just about 30 minutes left to go here, Scarlett, in the trading day.
And it's another day of modest moves, at least in equities. If you take a look at the S&P 500, by my count, this would mark the 14th straight day, if we close at these levels, where the S&P has not moved more than 1% by the end of trading. You look at the sector performances, and it's really a mixed bag here, with the decliners falling a lot more than the advancers. Energy stocks, all 23 members of the big cap energy stocks, are lower today as oil prices decline. You also have materials under pressure, along with industrials. On the upside, you've got technology gaining by 0.7%. Apple is in that category. Consumer discretionary and communication services, including the likes of AT&T and Verizon, are helping to keep that sub-index in the green.
Well, I'm glad you bring up AT&T, because take a look at the ADRs of Nokia, down about 5% here in the U.S. The shares over in Helsinki dropped about 10% here on the day. This after its Nordic rival, Ericsson, won a $14 billion contract from AT&T to modernize AT&T's 5G network. Now, this is a big snub to Nokia. Remember, AT&T had actually relied on Ericsson for maybe about 2/3 of the structure for its network, and on Nokia for about 1/3 of that. But this new contract basically puts most of this under Ericsson's umbrella. Furthermore, there's no real restrictions on maintaining the relationship solely with Ericsson, meaning AT&T can go out and find other partners as well, but Nokia is not necessarily going to be a part of that. American Express down about 1% here on the day. Some interesting comments by the CEO over at that Goldman conference, basically saying that billings in October were actually down from the third quarter, and billings in November were effectively flat. So that's basically the setup now for what those fourth quarter numbers may look like. Meanwhile, CVS gave a forecast that investors seem to like, and we're going to get a lot of results after the bell tonight. We talk about Toll Brothers, but we get 3 software companies, Asana Box and MongoDB. MongoDB up 2% here on the day, coming off a 5-week rally. Scarlett.
It always surprises me how many application software companies there are out there. All right, we'll continue to keep an eye on those names, and of course, we'll break those numbers when they cross. Meantime, let's move over to healthcare, because a new weight loss drug is hitting the market. Eli Lilly's Zepbound is now available in U.S. pharmacies, and unlike rival Wegovy, Zepbound promises to be more widely accessible. Joining us now is Madison Muller, Bloomberg News healthcare reporter. So this is long awaited, and it just means, Madison, that people have more options if they're looking for some kind of weight loss drug, right?
Exactly, yeah, and especially as Wegovy has been in short supply now for a little bit over a year, actually, and it's very difficult for patients to find. So the fact that Zepbound is now on the market gives them another option, especially if they're struggling to find a prescription.
Give us a sense where we stand right now, because it's kind of confusing as to what's out there, what's still coming. So right now, your options are what?
So right now, for weight loss, the options are Zepbound from Eli Lilly and Wegovy from Novo Nordisk.
And what's in the pipeline?
And so in the pipeline, there's a lot coming. I mean, we just heard about this Roche deal. Roche is now entering this space. Pfizer is trying to develop a weight loss pill. Amgen's developing a weight loss pill and a shot that's taken less frequently. So there's lots coming.
You didn't mention Ozempic, though.
So Ozempic is a diabetes drug, and that's the one that, I mean, everyone knows about Ozempic. It's become a household name. It feels like it was kind of overnight. But Ozempic is a diabetes drug, and patients do see a lot of weight loss, but if you're using it for weight loss, it's usually used off-label.
Well, isn't that a lot of that going on, though?
There is a lot of that going on.
All of Hollywood.
This gets to the whole thing, like who was jumping in the pool. There were some comments crossing the terminal a little while ago from the J&J CEO giving a presentation, basically saying that they are not going to enter into the GLP-1 race, at least for now.
Yeah.
But this seems to be a reiteration of some comments he made before.
Yeah, so J&J is having its investor day today, and the CEO was actually in our office about a month or so ago, and he made some comments saying that, you know, this seems to be sort of a fad, and within a few years, you know, healthcare will be on to the next thing. And I think that that's not really what investors want to hear. I mean, when we're looking, you know, listening in on earnings calls this quarter, all of the healthcare calls, analysts just want to hear about GLP-1.
That's interesting that he would use the word fad.
Yeah. I mean, I don't know if he used exactly the word fad, but a trend. Sort of didn't see it as a long-term thing in healthcare.
Obesity is a structural problem in the U.S., not a trend, not a fad.
Right. And it's definitely going to persist for
But what about all the money that's been put into this, too? I mean, because I also feel like when we talk about trends and fads, you know, when corporations put that kind of money into developing these types of drugs and finding new applications for them, you know, they're going to try to make sure this is more than a fad.
Right. And that's what we're seeing. Experts are saying, too, that we're really at just the beginning of this market and of this science. I mean, this is sort of the first stage of what is likely to become many more different applications, indications. They're studying it in all, you know, GLP-1 drugs in Alzheimer's, kidney disease, liver disease, and the science that's coming is more impressive than what we have right now. You know, Ozempic 2.0 is sort of already on its way, and you know, to not recognize that is.
Yeah, a little short-sighted. Let's talk a little bit about pricing, because the price of Zepbound will be $1,060 for a month's supply before rebates. How much can rebates take that down?
So rebates, I mean, it sort of depends on your insurance plan, and right now what we're seeing is insurance is a little bit spotty. So Medicare doesn't cover these drugs, doesn't cover weight loss drugs. Medicaid, it sort of varies by state. Some commercial plans cover them, and so the rebates, they can take the cost of the drug down, but it's still pretty expensive for most people right now, and sort of depends on your situation.
Yeah. All right, Madison Muller, thank you so much, keeping us up to date on the latest with these weight loss drugs. Bloomberg News' Madison Muller. And Romain, it's interesting when you look at pricing, because this is it doesn't matter for a lot of people. They're going to pay whatever it takes to get to this. And because you have to keep paying it, you have to keep taking it in order to keep the weight off.
Yeah.
It's recurring.
And there's been a lot of discussion about what happens if you go off of it. I mean, obviously, you know the side effects when you're on it, but there are some significant side effects once
What are the side effects when you're on it?
Well, do you want the TMI? Well, I mean, it's the ones we've talked about a lot, nausea, bowel issues, and things like that. Those are like the more common ones. But it also gets to the broader issue, too, that, and Madison was kind of touching on this, if this does prove to be a drug that can not only lower your weight, but more importantly, improve your health, then you would think that the insurance companies at some point will come around to it and realize that longer term, they're going to save more money by having people on these drugs and not on them.
Preventative health care.
Yeah.
Oh my gosh.
Yeah.
What a concept.
No, they don't believe in that.
All right, we've got a lot more coming up on the close. Coming up, our top three. This is our new segment where we focus on the top three movers and shakers at the center of the day's biggest stories.
Who's shaking?
We'll tell you next. This is The Close on Bloomberg. It's time now for the top three. Every day at this time, we take a deep dive into the people at the center of today's top stories. Romain, who do you have your eye on?
Oh, let's start with Mark Rowan, who leads Apollo. Team Surveillance had a chance to actually go down to Apollo's headquarters. They did their broadcast from there, and they got some thoughts out of Mark Rowan about the state of the private markets and whether, I guess, they were a better deal than what you get in public markets. Let's take a listen as to what he had to say.
If you actually want alpha, outperformance, you need to step away from public markets. And I think that's happening because we're also revisiting the notion of public being safe and private being risky. This is the framework we used to be in. Private meant venture capital, hedge funds, private equity. Now it just means less liquid.
And that was Mark Rowan there. And of course, those comments are what you would expect from a guy who leads one of the biggest private capital firms out there. But it also gets to this idea that he didn't actually cite actual numbers for returns, because when you look at private market returns over the last couple of years, they have lagged the public markets. Obviously, it's going to vary depending on the firm and, more importantly, the individual funds you're in. But on an aggregate basis here, they are lagging. Now, he is making a point, though, about risk-adjusted returns as well, and about active management and the idea that active managers in the public space can't necessarily keep up with the active managers in the private space. I'm not sure if that's completely true, but that's his view.
It sounded very much like a pitch that he would give to his investors.
Yeah, I mean, he's talking his book. That's what he's supposed to do. That's why
Apollo has, what, $631 billion in assets under management?
Yeah, who's counting?
They are, I'm sure. I'm watching Dave Stevenson. Dave Stevenson is the Airbnb CFO, who was actually just promoted to Chief Business Officer. This is actually a new role overseeing the home-sharing company's business strategy, including its overseas expansion. And we know, Romain, that Airbnb is at an inflection point, right? It bounced back from the pandemic lull. It slowed down from the post-pandemic boom, and it's got a lot of things that it has to contend with now, especially in places like New York City.
Yeah, absolutely. And, look, anytime you see an elevation like this, the first question becomes, what's this person's trajectory here? And I mean, look, I don't want to speculate too much, but the idea that Chesky would think to sort of give him that type of responsibility, and effectively he is going to be the strategy guy for sort of expansion, or at least, improving this business here. And I guess if he does a good job, maybe the sky's the limit for him.
Maybe the sky's the limit. We know that Chesky has hinted at a couple of changes to come for Airbnb. Integration of AI, what else is new? And third-party services.
Third-party services, what does that mean?
I don't know.
Maybe is an Airbnb technically a third party already?
There's going to be more experiences associated with your stay at the Airbnb.
Oh, I got it. Right.
Something to that effect.
Oh, okay. Well, it's interesting. Look, they got to try something new, and Chesky's taken this company pretty far. And at some point, you always need to kind of hand some responsibilities off to other folks.
It's about the value add.
Take it even further here, and he seems, at least his pedigree on paper, I mean, he seems good enough than anybody else. It'll be interesting, too. Another person in the news that I've been keeping an eye on is the CEO over at Alaska Air, Ben Minaguchi, basically saying, an interesting story on the Bloomberg terminal, I should say, kind of profiling him and what they call the iron fist and silk glove approach that he has taken in running this business, but more importantly, how that is going to help or maybe hinder efforts to get this deal through regulators. The tie-up with Alaska Airlines is certainly going to face some regulatory scrutiny, but he seems prepared for this fight. And there are a lot of companies that have kind of looked in the face of DOJ and the FTC and said, look, we're ready to fight for these deals no matter what you're going to do to us.
And there's a great anecdote in the Bloomberg News story where he, during the bidding for Hawaiian Holdings, actually dropped the purchase price to get the best value. You don't normally do that when you're trying to convince someone to sell yourself to me.
Yeah, and there was interesting comments. Remember when this was first announced, there was a great quote. I can't remember who it was. It didn't come from the CEO of Alaska Air, but it was the idea that you aren't going to do a deal unless you thought that it can get through the antitrust regulators. In this environment, you don't even announce it unless you have some confidence that you can do it. So this profile of him really seems to make the case here that he's willing to lawyer up and do whatever he needs to do to, I guess, to keep the regulators at bay.
I think it said that he's willing to get into a street fight. Maybe he'll need to get into a street fight. Like, he's aggressive, he's hard-nosed, he stands his ground.
Okay, I hope there is no actual street fight, because I don't think, actual brawling in the streets is actually the solution. Peace is the answer.
Peace is always good.
Peace some lawyers.
Lots of lawyers.
All right, coming up here after the break, we're counting you down to the closing bell. Just about 15 minutes until we get there. Andrea DiCenzo going to be joining us, co-portfolio manager over at Loomis Sales. This is The Close on Bloomberg. This is the countdown to the close. Romaine Bostic here alongside Scarlett Fu with 10 minutes, Scarlett, until we get to those closing bells.
Yeah, and I'm looking at the rally and Treasuries continuing, the 10-year yield falling below 4.2%. This is now a 3-month low. So Treasuries are back to rallying on this cooling jolts data that we got today, and investors are thinking maybe this portends for a coolish jobs report on Friday.
I wonder how much further it can go, because we're now looking, at least on the 5 and 10 year, basically around 4.2. And now you're talking about a situation where could we drop below 4? Because I feel like it seemed like a month ago everybody was saying, well, not only were we going to be above 5, but we could actually be up somewhere near 6% and do your insurance.
This is the bond market of 2023. Anything could happen.
Yeah, absolutely. I don't know if we're ever going to see volatility like this again. Definitely a trader's market for those folks brave enough here. Well, let's try to get some insights out of somebody who knows a lot more about this than us. Andrea DiCenzo joining us, co-portfolio manager at Loomis Sales and Company, joining us today in New York, down from Boston. Great to have you.
Thank you for having me.
When you look at, I guess, the optimism that had been priced into this market, optimism which seemed to be around a soft economic landing, optimism around multiple rate cuts next year, and optimism around God knows what else, do you think that maybe things have gone a little bit too far beyond where we should be?
I don't know if we've gone too far. I think it's fair to assume that, maybe 100 basis points of a rally that tends to be 100 to 150 we start to see once we believe the Fed is done with their hiking cycle. And we're about 100 basis points into that if you think about the 10-year. So maybe not too far yet, but I think it's important to start to think about what is driving this rate rally. Is it concerns about softer growth? Is it concerns about a higher unemployment rate? Because at some point, that will start to impact that risk sentiment that we've seen, really driving the risk rally across riskier asset classes like triple Cs or even equities.
Well, that gets down to the nitty gritty, which is always corporate fundamentals, right? And they surprised to the upside this year. Let's just face it. A lot of people thought that we were going to really see this massive profit recession, and we sort of pulled ourselves out of that pretty quickly here. When you look to 2024, do you see that sustaining itself?
I think we have a window of opportunity of risk-taking, probably into the first quarter. But then we are going to start to see the impact of the consumer rolling over. And that is going to have implications to corporate balance sheets when you think over the longer term. But also we need to be thinking about where are you being paid to take the risk in the market today? With equity risk premiums where they are, is it more attractive in fixed income markets? And I think just now as we're starting to see that rate picture shift, the narrative towards cuts, it is beginning to be more attractive in that area.
So I want to dig into that idea of the consumer rolling over a little bit more, because during the break we were talking about the soft landing, this assumption that things will be okay. The soft landing, it's not universal, is it? It's not across the board. Where do you see it being harder for some segments of the population than others?
Sure, exactly. To your point, it's not a soft landing for everyone. I think if you're a lower income or lower FICO score borrower, you're already feeling the pinch of that tighter financial conditions. I mean, you can't pick up a journal without reading about higher delinquencies on credit cards, higher delinquencies on auto loans. That consumer base is not borrowing at the same pace that they were 18 months ago. So they already are beginning to act a bit more recessionary. Now, that middle income borrower is maybe still grappling with, should I prepare for a recession, or am I going to skate through this okay? If you're a high FICO score, you're probably still spending it the same way you used to. You're maybe just on the margin shifting.
So how does that affect the companies that cater to these different consumer segments, their ability to fundraise, and more importantly, their ability to service their debt?
I think the servicing of the debt has not yet begun to be a problem because we've seen the market open to them. Even the lower quality high yield borrowers are able to still come to market. I mean, when you think about the appetite that you've seen in single Bs or triple Cs, it's really been an outstanding year to date for that segment of the asset class. Now, when will that begin to be a problem? I think when you look out over the next 2 years or maybe even 14 months or so, that debt wall of maturities in the high yield market is going to be something that we're all going to be talking about.
I am curious about how the rest of the world sort of, I guess, correlates with what we're seeing here in the U.S. We came in this morning, there was a lot of talk about the Moody's downgrade on China, a lot of concerns about economic growth in the world's second largest economy. Are you concerned?
I think the Moody's downgrade is reflective of the same downgrade we saw take place in the U.S., is that when you start to, just really trash your balance sheet, for no better term, you're going to see a downgrade occur. So with that leverage increase, that Moody's has downgraded them. Now, I don't think that's backwards looking. So I think going forward, it's what's the implication of that increased debt or increased leverage to their balance sheet? It's really done to spur growth. So if they are successful at doing so, I think that's really going to be a tailwind, and it's an important tailwind because so far it's been the U.S. driving growth. Yeah. If we see kind of resto world drive growth on a relative basis, that has much broader implications for emerging markets, for that dollar bear market to resume, and really it starts opening up opportunities on international markets as opposed to just U.S.
And we should just clarify, it wasn't a downgrade, it was a downgrade to the outlook.
Yes,
so
yes, a reduced outlook. Yeah. So if that's the case, and people do start looking at China and some of the emerging markets with renewed enthusiasm, where does that money come from? Does it exit something like the U.S. or developed markets, or does it come off the sidelines?
I think probably a little bit of both. I mean, there is a lot of money on the sidelines. If you look at emerging market, just sort of dedicated investors, on average, they're underweight versus the benchmark exposure in China. So should China really begin to pull themselves out of this lower growth narrative, I think you could see money flowing back in to cover that underweight versus the bench. But it's not just China. Latin America has proven to be a really attractive investment, and I think you could start to see more interest in frontier Africa also if China begins to grow again.
Are clients, are they interested in that though? I mean, it's one thing from a wonky perspective to say, okay, here's where the value is, but do clients want that exposure?
We have a lot more clients recently asking about it, so that's the difference here. With volatility, you know, where it is across all emerging markets at this point, they're finally saying these yields might be paying me for that volatility. So what is the tailwind and what is the catalyst is the conversation.
All right, Andrea, a great conversation, and always appreciate you coming down to New York. At some point, we got to come up to Boston to see you guys. Andrea DiCenzo, co-portfolio manager over at Loomis Sales. Scarlett, as we count down to the closing bells, less than 3 minutes to go.
Yeah, and it looks like a pretty meh day in equities. Not a whole lot of movement when you look at the benchmark indexes, although the Russell 2000 giving back some of its gains over the last couple of days.
Yeah, and this is like the weird oscillation, right? Every time we think we see a trend breaking out, then it just kind of flip-flops in a couple of days, and I don't know, a couple of days back, we'll be flip-flopping back again.
Yeah, I mean, they're pretty vulnerable, especially the financials, because they're so attractive on a valuation basis, but then you look at the fundamentals and people are saying, but there's still a lot of costs that they have to bear in this environment.
All right, we are getting closer to those closing bells. A lot of coverage coming up as we are expecting some earnings, including out of MongoDB and Toll Brothers. Stick with us as we take you to the bell and beyond. Interesting day in the markets here on this Tuesday afternoon. The S&P lower here on the day, as was the Dow. The only bright spot was actually the NASDAQ, which was only up fractionally on the day. But you see the sell-off that we saw in the Russell 2000 coming off a 4-day run, particularly that big run that we saw on Monday as well as on Friday. So giving back some of those gains as we get the flip-flop and the oscillations here. A flip-flop in the Treasury space as well, with yields now going in the opposite direction of where they were the previous day. Some of the individual stories on the day, including JetBlue Airlines down about 4% here on the day, as DOJ wrapped up closing arguments in that case, that antitrust case that is seeking to block the tie-up with Spirit Airlines. Meanwhile, Toll Brothers, we're awaiting those earnings coming after the bell in just a moment. The shares didn't do a whole lot during the day leading up to that, though they had been on a pretty decent run in the days prior. Coinbase giving back just a little bit from that monster rally, and AT&T shares up about 3% here on the day on the back of that news of an upgrade of their 5G system here, a new contract with Ericsson to help do that. Meanwhile, when we talk about the market sentiment and more importantly, expectations of market volatility, those expectations have basically been non-existent. The VIX continues to hit cycle lows once again and again and again. And Abigail Doolittle was talking a little bit earlier about the potential for a pop higher in the VIX. And there are a lot of technical fundamentals underneath the hood that does suggest that maybe we could be in store for a little bit spike higher. But let's not forget this, Scarlett. That prediction has been made time and time again over the course of this year. And every time, people have been wrong.
And we're still waiting, right? Well, that is the story with public markets. Let's talk about the private markets, because earlier today, the Bloomberg surveillance team spent some quality time with the top executives over at Apollo. The alternative assets giant's co-head of private equity, Matt Nord, says investors are right to be skeptical of private market valuations.
I think a lot of sponsors overpaid for assets the last couple of years. And the air is very slowly coming out of that balloon. And so I think you can question some of the private market valuation multiples. Again, for us buying at 6 times, we tend to see multiple expansion when we sell it. So I don't have that concern for our business.
Are you investing in non-profitable tech?
No, that's not for us. Okay. We like cash flow. We like cash-on-cash returns. We're very happy with our model.
So just for our audience, which is fascinated by this, you're coming in at 6 times EBITDA, down the income statement, some form of balance sheet construction. How long is your expected duration on a blended basis to where you take that out? At what level of EBITDA? Are you going from 6 to 9? Or are you trying to pop this thing with leverage out to 12 times EBITDA when you exit?
No, so we're underwriting to conservative assumptions. What we want to do is return capital along the way. So the average hold may be 4 or 5 years, but I think this is one of the biggest issues for the industry is how much capital has been returned. And for these sponsors that have overpaid for assets and over-leveraged, it's very hard to generate returns. For us, if you look at Fund 9, we've already returned about $10 billion of capital. We've already returned about half of our invested cost basis, which is best in class for that vintage. So it's another benefit of buying well. So we've taken companies public, we've sold assets, we have a lot more flexibility.
Well, in the shadow of Charlie Munger, with all that we've studied of him in the last week and the death of the giant, I mean, what it comes down to is you're getting a preferred cash flow along the way.
Correct.
Give us a number on that. Are you picking up, not over LIBOR, but over a conventional buyback dividend, are you picking up another 300 basis points off that?
It's a great question. So when we target our returns, let's say 25% base case returns, we're typically underwriting to about 10 to 15% cash-on-cash yield in the first year. And then earnings growth, and then we have a team of operating partners that can help really drive further value creation from there, but it starts with that cash flow yield.
And that was Matt Nord, of course, the co-head of private equity over at Apollo. And Romain, he says that the key is to return capital along the way. That means you have to have a better IPO market in 2024, which has been something that's been kind of missing in 2023.
Yeah, I'm always fascinated by these guys because this was kind of the year where everybody thought they were really going to just fall off a cliff. Mm-hmm. And the big narrative at the start of the year was, don't worry, private markets are a lot healthier than public markets. And don't worry, the returns aren't necessarily there. But they've proven over the course of this year, at least the demand for it, the clients. And these guys, I mean, look, they got swagger right now because everybody wants a piece of them. Everybody thinks that they can have it, but they got to have the returns. Because you know what else I heard from a lot of LPs early this year too, is that they did not get the returns that they were promised from the last funding cycle. So that there's a big question as to whether they're going to get it going forward or whether they're going to buy in to the idea that whatever they're pitching, they're actually going to get.
Yeah, now they're getting a little impatient as well.
Yeah, so I mean, this is the yin yang, but we know the importance of private markets is just a lot more critical than what it was a few years back. All right, Scarlett, let's pivot from that. We actually have some breaking news here. This is on MasterCard. You like buybacks, Scarlett?
Investors do.
Well, you're going to get $11 billion worth of share buybacks out of MasterCard. That crossing the wire just a little while ago. And we started to see a resumption in some of the buyback activity as of late here. Of course, the GM was a big one that we heard from last week. That was, $10 billion, if I remember correctly. Now MasterCard getting on board here with an $11 billion share repurchase program. All right, we're going to get some more details on that, and we are still awaiting those results out of Toll Brothers. We'll bring you that as soon as we get them as well. In the meantime, when we come back after the break, we're going to take a look at generational wealth and a big transfer in some of that generational wealth. Katrina Robinson over at Cohn Marshall going to be joining us in just a second. This is Bloomberg. Welcome back to The Close. The focus right now on wealth and the great wealth transfer. Aging baby boomers starting to pass down their wealth to the younger generations. According to Cohn Marshall, an advisory firm, more than 1,000 billionaires are going to pass $5.2 trillion to their children over the next 20 to 30 years. Joining us to talk about succession planning is Katrina Robinson, the CEO of Cohn Marshall. Great to have you here in studio.
Thanks for having me, Romain.
Before we get to the billionaires, let's talk about just us mere mortals. And there are obviously a lot of folks out there, our parents and grandparents, who are either at retirement age already or getting close enough to that where they really have to start thinking about how they're going to handle their assets and pass them down to their heirs or whoever they want to hand them down to. How is this wealth transfer going to compare to wealth transfers that we've had in the past in terms of size and scope?
Well, that's such an important topic. I think this wealth transfer that we're anticipating is probably going to be one of the biggest that we've ever seen. Mm-hmm. I mean, Americans are wealthier now than they've ever been. And we're at a place where the boomer population is quite significant. And there are going to be so many people, younger generations, who are going to be having to make decisions as to how to deal with wealth that they may inherit. And I think it's
Yeah. Well, I'm curious too, because I mean, when we talk about estate planning, I mean, compared to just investing, estate planning just seems completely just mind-boggling to me, because there's just so many moving parts, because you're not only just talking about what you're giving and who you're giving it to, but obviously a lot of taxation issues in terms of how you give it and when you give it here. So what do you do? What do you tell clients in terms of the approach that they should take in trying to figure out what's best for them?
You're absolutely right. It does take a lot of planning. And I think before someone sets up an estate plan, it's better to consult with a number of advisors. Usually people consult with a lawyer, an accountant, their banker. Certainly family members have to be included and involved in the conversation. But it's a team approach, and the trustee is one part of that team. But we work typically in tandem with all the trusted advisors of a client or a family.
And a lot of families create trusts for their children, for their heirs. What's interesting is that they're going to Montana to do so, or they're going to Wyoming to do so. Excuse me, I'm getting my states mixed up here. Why Wyoming in particular? What kind of laws are there that enable this?
Thanks, Scarlett. So Wyoming is one of a handful of states that have really decided that they're going to make the trust industry something that they're known for. And they've decided that they're going to be really focused on families, wealth transfer, what do people want, how to make it actually easier for families to transfer wealth to their children, to a nonprofit, to a charity, to whatever they would like to do. And so there's a lot of flexibility in what you can do with Wyoming trusts. And I think that's why it's become so popular. And we've seen such a high growth of inquiries in terms of Wyoming and curiosity. It's a very private state, so we'll never have definite figures as to as to numbers.
They like it like that.
They like it like that, exactly. So, I mean, within the United States, you're seeing a lot of people flock to Wyoming. How about globally? Because clearly this is an issue for a lot of families in Asia where family-run businesses are big.
Absolutely. There are a lot of family-run businesses. There's a lot of wealth being created in Asia from family businesses, and a lot of families are interested in moving to the United States, investing in the United States. And as part of that pre-immigration plan, what we're seeing is thinking about how do we set up or structure in the United States to hold our wealth that we'll generate in the United States. And so because of that, there is a lot of interest. There's maybe talk of Asia-U.S. pipeline in terms of or trust business.
I'm curious why we haven't seen, I guess I kind of know the answer, but why we haven't seen a little bit more activity in Washington to kind of address some of that. Because there's just so much disparity now, and even when we talk about Wyoming, how they could kind of go on their own, and you do wonder if other states maybe will say, well, we want a piece of that as well, so why shouldn't we be the trust capital of the United States?
Well, I think other states have definitely been trying to get in on the action, and I think we're probably going to see this as a trend that more and more states are going to be thinking about how do we become more attractive, because I think most states would like to keep some of those structures and that part of the industry in state.
So talk a little bit about what the first conversation should be like in terms of talking about taking the first steps towards planning for your trust and succession.
So one of the first questions I think someone should think about is, what is my goal? What do I want to achieve? For most people, they want to take care of their children. They want to take care of people that they love. They could also want to take care of other members of their family. And some people may think, well, actually, I need to help to plan for succession of my business. I need a structure to hold my business. And within that structure, I can plan for who will take charge of the company when I'm no longer here, or if I choose to do something else. Sometimes people are migrating. They could be migrating from one state to another. They could be coming into the United States. Sometimes they're leaving the United States. Trusts all come into play when there's a big life change like that as well.
Yeah, are there residency, particularly with Wyoming, are there residency requirements, or does that not matter?
So there are two ways to be a Wyoming trustee. One is you could be a Wyoming resident, in which case you live there and you could be the trustee of the trust, or you hire a professional trustee like Teton Trust Company.
Like Teton, which is under the umbrella of Cone.
Under the umbrella of Cone Marshall, and then you could live anywhere in the world.
Okay, all right, I like that. I mean, Wyoming's nice, but I don't know if I want to move there.
Yeah, well, I mean, that's a big question. Do you have to actually have a presence there and maintain? Are there residency requirements, or is it just something you can park your trust there and move on with your life?
Well, typically you would have, say if you're not living in Wyoming, you would have a professional trustee company that's licensed in the state of Wyoming. So you have to be a licensed trustee company to act as a trustee if you're not just a resident trustee. a resident individual trustee, for example. So, we're, for example, a Teton Trust Company is regulated by the state of Wyoming.
Gotcha. How long have you had that subsidiary or whatever you refer to?
It's 8 years old.
8 years old. Okay.
Yes.
So were you kind of ahead of the trend, or?
I would say we were on the earlier side.
The earlier side.
There have definitely been more trust companies chartered since we received our charter.
Mm-hmm. You think there's going to be more competition in that space?
I think so.
Yeah, you think so?
I think so.
I mean, everyone's kind of the cat's out of the bag. Yeah.
I think every year we're notified having a license that there are more license applications, and we get a little idea of the business plan. I do think there's still growing demand to have this.
And it's not just like billionaires using this. I mean, you have just mere millionaires also doing it as well, right?
You have mere millionaires.
Okay.
You have people who are planning to be wealthy.
Yes.
People who are early days in their entrepreneurship, who know and are very ambitious in terms of the wealth that they plan to create.
Yeah.
Katrina, really appreciate your joining us today. Katrina Robinson is CEO of Kuhn Marshall, a firm that helps clients handle trust, estate planning, and asset preservation, wealth planning, and more. Coming up, we've got the National Association of Home Builders CEO giving us his take on the outlook for housing. This is The Close on Bloomberg.
All right, well, the Tuesday trading day is now in the books. A bit of a crab walk here for U.S. equity markets with the Dow and the S&P moving lower here on the day, but only fractionally. Fractional moves higher for the NASDAQ, while the Russell 2000 was your big laggard. But once again, most of the action, most of the volatility was in the Treasury space. A flip-flop of what we saw yesterday with a big move in yields right now. Take a look at the 10-year yield right now. We're under 4.2%. Remember, just about a month and a half ago, we were above 5% on the 10-year. So the idea that we've come this far so fast is raising a lot of questions as to whether some investors have gotten a little bit over their skis. Nevertheless, a lot of economic data this week, as well as quite a few earnings, Scarlett, could shape the narrative going forward.
Yep, and we just heard from Toll Brothers, the home builder, with its latest results. It was a beat and raise quarter for the home builder. Fourth quarter earnings per share coming in at $4.11. Analysts were looking for $3.72. Revenue of $3.02 billion, also higher than the expected $2.78 billion. And as for the coming quarter, the coming year, Toll Brothers sees first quarter deliveries of 1,800 to 1,900. Analysts were looking for, on average, 1,726. So if you look at the stock price, moving up just marginally here in after-hours trading. Do you see anything else, Romain, that catches your attention?
Yeah, nothing really jumps out at me. I mean, you're looking at the sales, but more important, you're looking at the deliveries. Yep. And I thought that was interesting, too, because the idea here was that they thought we were going to see a slowdown in deliveries, and that's still holding firm. That's still higher, and the backlog is still there. I mean, I know it came in slightly below estimates, but you're still talking, what, 6,600? That's pretty good.
There's a lot of demand for homes out there. So let's bring in Bloomberg Intelligence analyst Drew Redding. Drew, this is a beat and raise quarter, but the after-hours reaction is not large. What do you see here? What gets your attention?
Yeah, so the two things we're really focused on are orders and gross margin. It looks like orders came in a little bit softer than what the street was looking for. But as we discussed previously, not all unexpected, because you have to remember, Toll did face 8% mortgage rates in October, and we did see somewhat of a slowdown during that month. In terms of gross margins exceed expectations. The outlook remains strong. They're one of the most profitable builders in the space. So I think that's something that investors are going to latch onto. But again, more importantly, I think we're going to be listening for the call to see how demand trended through November and the first weekend in December. And some of the data that we've looked at recently across the industry shows an above seasonal improvement in demand in November.
There's been so much talk about demand, supply, what they deliver, what they don't deliver. What about costs, Drew? Because I felt like that was a big story a couple of years ago when the pandemic really just raised the cost to build these homes here. Is that a little bit more under control?
Yeah, it's a good question. And, the supply chain as a whole has gotten a lot better for the home builders. You're seeing cycle times, which is the length of time it takes from the time you sign a contract to getting a house delivered. They're getting more in line with what is typical for the industry. Costs are starting to improve a little bit. And you see that in Toll's margin numbers. Unlike some of the other builders, which are more focused on volume and are willing to chase those incentives to drive traffic, Toll's more willing to hold the line on pricing because they really want to protect protect that industry-leading gross margin.
Yeah, we talk about mortgage rates and how, they're more than 7%, hitting 8%. A lot of construction companies, a lot of builders offer incentives and rate buy-downs to keep it at something more palatable, like 5.5%. How does that show up in Toll's results? Does it show up in the gross margin?
So it's different depending on the builder. For the most part, those adjustments to incentives show us a reduction in the average selling price. So it would show up in the top line, which at the end of the day does funnel into gross margins. And like I said, Toll compared to some of the other builders is a little bit less willing to chase incentives just to drive traffic. They build more complex homes. They take more development risk in the land that they're developing to complete these homes. So they want to be rewarded on that margin line.
All right, got it. Thank you so much, Drew Redding of Bloomberg Intelligence with the instant analysis on Toll Brothers results, a beat and raise quarter here for the home builder. Now, for more insight on the home building sector overall, let's bring in Jim Tobin. He is president and CEO of the National Association of Home Builders. Jim, good to speak with you. How representative of the home building sector is Toll, would you say?
Well, I think Toll Brothers is a small portion of the home building industry. Obviously, they're in the high production portion of the industry. I know the members that NHB represents, they build about 80% of the homes in America. Build probably fewer than 25 homes a year on average, and employ less than 10 people. So really small businesses that build the bulk of homes across the country.
Well, get to the brass tacks here. I think everyone wants to know when we sort of get, or if we ever get there for that matter, to some sort of, I guess, balance. The idea that we know there's such a huge shortage, and we know that the home builders are doing whatever they feel they can do, at least in a way that's profitable to them. But do you think that we're any closer to achieving a little bit more balance in terms of supply and demand?
I do, actually. I feel more comfortable that we're going to start to meet that demand next year, obviously coming off a very slow year where we saw our forward-looking housing market index really start to crash over the last 6 months. I expect 2024 to be a much better year for us. I think we are looking at small gains in home construction in year over year. I expect interest rates, at least from the Fed, to start moderating in the second half of the year. Obviously, we see the rally in the 10-year Treasury market, which has driven those 30-year fixed-rate mortgages down. Where the break-even point is, I don't know, but certainly anything that gets farther away from 8 and closer to 6 or 6.5 is good for the market. But we still have outsized demand for housing in this country. Yeah. We still have existing homeowners sitting on the sidelines, locked in their 4% mortgages for the short term, which makes new home construction making up an inordinate amount of the marketplace month to month. In fact, new homes are actually making about 30% of the market when they're traditionally closer to 10 or 12%. So we're still the best game in town.
I'm curious about the efficiency, though, in building this from a cost perspective. I asked our previous guests over at Bloomberg Intelligence about whether the cost to build these homes is sort of moderated a certain extent from what we saw during the pandemic. We know that the supplies themselves were more expensive, but so too was the labor. And we know that the labor market is still relatively strong.
Labor market is incredibly strong. We face a skilled labor shortage when it comes to home construction. We're about 400,000 workers short month after month, and this has been going on year after year. In fact, probably up to a decade at this point. So skilled labor continues to be a drag on our industry in particular. You're right about supply chains. They certainly have moderated. That's one of the headwinds we're worried about as we believe we're going to pick up in home construction over the next 3 or 4 years, is whether the supply chains are ready to meet that demand. We saw what happened after COVID when the home building sector really took off and kind of defied economic gravity during that time. Our supply chains ready to meet that demand again? But we do see that the cost to build a new home is down, but it's still, the interest rates, borrowing is still high, and land as well.
Yeah, and speaking of land, one thing that you point out you're worried about is that there's not enough land available, not enough lots, given that lot development is constrained by higher rates. Does that increase the likelihood of teardowns where you buy a home that people, it hasn't been upgraded in a long time and people tear it down to effectively create new construction there?
Yeah, that's a trend, and obviously you're close in suburbs across the country around the big metros. That trend will continue, so which means our remodeling sector, while it's flat this year, we expect that to begin to take off in 2024 as well. But then we're also going to see the ability. It's contingent on local governments being part of the housing solution by opening up new land, working with builders and developers to make sure that land is available at an affordable price, so an affordable product can be built for homeowners.
There's this new thing called the alternative dwelling units. How big of a deal is that for the home builders that you represent?
It's a big deal in those markets that are constrained, like you said, in those inner ring suburbs or in city centers themselves. Being able to rezone is really, really important. Or allowing these ADUs, it's a critical. It's one of the big pieces to the housing affordability crisis and the supply crisis. We have to be more creative to get more units in the marketplace, so we can drive the costs down by putting more supply out there.
Jim, really appreciate you taking time to be with us today. Jim Tobin, he's the president and CEO at the National Association of Home Builders. All right, coming up here on the program, the CEOs of some of the largest banks here in the U.S. scheduled to go to Capitol Hill tomorrow for an annual talking to by Congress. Catherine Judge is going to be stopping by the big program to talk about not just what Congress wants to hear, but more importantly, what those CEOs want to tell Congress.
We're focusing on banks right now, and the CEO of Wells Fargo, Charlie Scharf, says the Federal Reserve's asset cap isn't doing much to limit its activities for now, but it could hurt its portfolio down the road. Here with more context is Daniel Taub. He is Bloomberg News' finance editor. Explain to us, let's just take a step back for a moment here, what this asset cap is, because this goes back to 2017, which is long before Charlie Scharf joined the bank.
Correct. Yeah, it goes back to the various scandals that Wells Fargo had, opening fake accounts and doing other things that regulators weren't too happy with. And Janet Yellen, it was one of her last acts as Treasury Secretary, put this asset cap in place. It limits Wells Fargo to $1.95 trillion in assets, which is their end of 2017 level.
But I'm curious about this. I mean, there's a reason why it's still in place. I mean, they were supposed to meet certain targets in terms of resolving some of those issues, and at least in the eyes of regulators, they clearly haven't done it.
Yeah, correct. I mean, they've been working on it this entire time. Obviously, it's a years-long process. Has to be looked at by independent analysts, and it's still in process. Scharf himself has not put a timeline on how long it'll take, but it's obviously taken years, and it's still in place for a while.
Is this something that is limiting the appeal of the bank to investors?
Well, the market cap has dropped in the time that it's about half the size it was back when the cap was put in place. I mean, it does limit the growth of the bank, so that's obviously something that's of concern to investors. Scharf today said that it's not hurting them for the moment, that there's enough, loan demand is down enough that they wouldn't be growing assets that much at the moment anyway. But he says, this could be a concern in the near future.
The question, though, is where would the growth come? We know they have made some pretty interesting pivots as of late that I think investors have applauded them for here. But even if these restrictions weren't in place, I don't think anyone really thinks that the growth rate would be so much that they would even be over the current caps where they are right now.
Well, yeah, and it's kind of what he said today, is that at the moment it's not a problem.
Yeah.
But, imagine the market changing a little bit. If interest rates come down a bit, if the economy starts growing a bit again, faster than it is at the moment, loans would be the place where it would grow. You can imagine businesses, individual consumers, mortgages are all places where people might borrow again.
You mentioned how the market cap has shrunk and Wells Fargo isn't allowed to grow any bigger than it was at the end of 2017. So where does Wells Fargo lead? Where is it best in class? Is it best in class in any part of the banking world?
Well, it's still, obviously it's still doing tons of investment banking. It's still a successful bank. It still has customers. It has pulled back on mortgages, as we've reported in the past. But, it's still one of the biggest banks in the country. It's not exactly disappearing. It just can't grow to the extent that a company like J.P. Morgan, which is a good example, that has grown quite a bit in the last few years.
Yeah, that's the thing. When everyone else is growing and you're not, then you end up falling behind.
Yeah. All right. Dan Taub, who helps lead our coverage coverage here at Bloomberg. We should point out Charlie Scharf is scheduled to be on Capitol Hill tomorrow alongside the CEOs of Bank of America, JP Morgan, Citigroup, State Street, BNY Mellon, Goldman Sachs, and Morgan Stanley. Now, ostensibly, this is that annual oversight, a hearing that they have over Wall Street firms, but all the talk is really going to be about some of the capital requirements currently in place and some proposals that are on the table. Catherine Judge joining us right now, professor of law over at the Columbia Law School, to talk about maybe, I guess, what all these CEOs seem to be grieving about. Catherine, we've already gotten the prepared remarks, and they're pretty much in line with what you think they would say, which is, please, please, no more restrictions on what we have to do here. Give us a sense here as to why, I mean, well, I know why they're saying that, but give us a sense here as to whether they have a case to make.
They have a case to make, but it's going to be a very difficult case for them to make. As a practical matter, a lot of what's going on is implementing international obligations under Basel III. The Fed has done so in a somewhat more aggressive way, but a lot of that aggressiveness comes in standardization, and that's trying to deal with the gamesmanship they've seen in the past with banks trying to use advanced standards to really favor their own interests over regulatory safety. So I think it is going to be a conversation. It's certainly going to be a much more contentious hearing tomorrow because of the proposals. And there might be some modest modifications that come out of both tomorrow's hearing and the overall comment period. But I think the Fed has really laid out its rationale, and we'll at least see the Democratic senators trying to play out that rationale tomorrow.
This gets to the idea, too. I mean, a lot of the regulations that they're pushing back on are really a long time in the making. Obviously, a lot of this comes out of the Basel Accords, the Basel III Endgame, where we're at now. And I think about the lobbying that has taken place over, I don't know how many years since we had the first one, but it's been a while. And they've done a good job at delaying some of this stuff, eroding some of the parameters around it here. And I do wonder, Catherine, whether they might actually win this fight.
You know, you never know for sure. That being said, there's a lot of ground that Vice Chair Michael Barr and the other bank regulators are standing on in trying to go forward with this. It is a hard time for regulation generally. I mean, part of the challenge we've seen is the judiciary has become very critical, in addition to members of Congress at times being more concerned about regulation. On the other hand, a lot of this is about international obligations. And also, while the story the banks are telling is really focused on small businesses and consumers, looking at that prepared testimony for tomorrow, some of the banks, such as Goldman Sachs, were frank that really a lot of the proposals are focused not on an across-the-board capital raise, but on particular types of activity, including market making and the support and the role that banks play in the capital markets. And I think they're likely to get a little less sympathy about the fact that they don't need to hold a little more capital to associate with some of those risks, and also just some of the operational risks that banks are exposed to today.
So the regulations were unveiled in July by the Fed and the other regulators, and now you have the CEOs speaking before Congress, testifying. Where are we in this process of these regulations being enacted? I know there's still a period where public opinion could be swayed, but are we kind of 2/3 of the way there, 3/4 of the way there?
I would say 3/4 sounds right, but it's always hard to know. So rulemaking at this point is a very long process. When he first took office, Vice Chair of Supervision, Michael Barr, undertook what he described as a holistic capital review. So he really looked at all of the other capital requirements that were currently put in place as a result of Dodd-Frank and subsequent regulation, looked how to best integrate the new requirements on top of that, and then came out with a broad proposal. That's what was introduced in July. You then have a process where the banks and industry, but also any other interested parties in the public can weigh in on what those ought to look like. And then there's a response where the Fed both rolls out its final rules and discusses any changes it made or reasons that it didn't make changes, even when it was requested. So you never have a precise understanding of exactly what the time frame is going to be, but they're certainly well along in the process.
And these regulations apply to U.S. banks only, or all banks operating in the U.S.? And I ask because I wonder if foreign banks that have operations here in the United States, whether you're a French bank or a German bank, are looking at these regulations and kind of cheering it on because it levels the playing field for them a little bit.
So it is going to apply to all banks that are operating in the United States, and it applies a little differently depending on kind of the nature of the bank. But really, this is going to help. I think level the playing field is probably a good term here. And part of what it's trying to do is to make sure that, given the whole variety of different activities that banks engage in, that they really are holding capital that's commensurate with those risks.
We were remiss in not talking about the role of private markets right now, Catherine. Earlier today, we had a great interview with Mark Rowan and a few other executives over at Apollo. We should point out there's no one from the private capital world on this list of folks scheduled to testify tomorrow, despite the fact there's been a lot of talk about expanding that umbrella of regulation to include private equity and private debt.
I think we might
That's certainly the case. So 2 things to note there.
Go ahead, Catherine.
All right, so one of the challenges that we have going on is that we are in a situation where we don't have anybody testifying, but FSOC is moving forward with having finalized its guidance. So there's the possibility eventually that we'll have a designation of a non-bank company. The other thing to note is we did have we had a letter coming from Senator Sherrod Brown and Senator Jack Reed, really concerned about private credit and concerned in part about the exposures the bank system might have to private credit. So you're right, the idea is disintermediation, but as a practical matter, banks do still have meaningful exposure. And so I think we very will likely to see questions about the rapid growth of these markets and what that means for risk generally and risk in the banking system at tomorrow's hearing.
All right, Catherine, always great to get insights out of you. Always smart. Catherine Judge, law professor over at the Columbia Law School. A discussion ahead of a big hearing that takes place tomorrow morning, 9:30 a.m. Washington time, where all the major bank CEOs here in the U.S. are scheduled to testify. We're going to set you up for some of the other big events that investors will have their eye on tomorrow. Stick with us. This is The Close on Bloomberg. Here's what markets are going to have their eye on Wednesday: economic data, ADP, jobs.
Yeah, and this is part of the trifecta of data that we get before the big jobs report. We got JOLTS this morning, ADP, and of course jobless claims, all leading up to non-farm payrolls on Friday and how the Fed positions itself.
And a big hearing in Washington, the Senate Banking Committee set to hear from the biggest bank CEOs here in the U.S.
Yeah, we're talking Solomon, Fraser, Moynihan, Diamond, Gorman, and Charlie Scharf of Wells Fargo.
Bank of Canada coming out with a decision tomorrow.
Yeah, not expected to do anything, keeping rates unchanged.
And we are going to get some earnings as well tomorrow.
Which one are you most excited about?
GameStop, even though I know it's not going to actually be actual earnings.
What are the fundamentals?
But it's always interesting to see, when they put out like a 2-paragraph earnings statement and no conference call. And an interesting interview tomorrow with the CEO of AMD.
Lisa Su, and of course this is on the heels of NVIDIA. They're gaining market share. I mean, NVIDIA's so far ahead, it doesn't matter, but they are kind of seen as the next best winner here.
Yeah, but of course, she was, before Jensen Huang stole the spotlight, she was kind of the rock star for a while. So interesting to see what she has to say, particularly about that AI strategy going forward. Scarlett and I will be back to break all that down for you tomorrow. Stick around, though. Balance of Power is coming up next, right here on Bloomberg.